Hi everyone and welcome to the webinar. I'm Stuart Wheeler, Partnerships Director at Achilles, and I'll be your host today. Over the next hour, we'll be looking into some of the implications that recent events like Brexit and COVID could potentially have on supply chain costs. Whilst these events may have offered UK businesses an unprecedented opportunity to explore new global relationships and re-examine their supply chains, there could be hidden risks in new and unexpected costs. Today, I'm joined by my co-host, Lee McDarby, CEO of UK International Payments at Moneycorp. Moneycorp are specialists in foreign exchange and international payments, often helping SMEs and supply chain managers to find cost-efficient ways to trade internationally. We're going to hear from two great speakers today. Dr. Adam Marshall, Director General, British Chambers of Commerce, where he represents and champions the interests of tens of thousands of business members from accredited chambers of commerce. And we're delighted to also welcome Vicky Price, Chief Economic Advisor and a board member at the Centre for Economics and Business Research. We'll have time at the end for questions, so please do add them to the question panel on the right-hand side. If we run out of time, we'll be sure to answer them all individually by email after. I'd now like to introduce our first speakers, Vicky and Adam. Over to you, Vicky.
Thank you very much. Thank you for this introduction. I'm delighted to be able to talk about the economy and where we are right now. This is, of course, a very uncertain time, but let me just take you through some slides that I've got. This is the latest forecast from the International Monetary Fund. It came out at the end of January. It's worth bearing in mind that right now, of course, we're not absolutely certain whether the precise points shown in this slide are going to indeed materialize. But what it is indicating very clearly is the very substantial drop in GDP in 2020 of 3.5% for the economy, world economy as a whole. Within that, the advanced economies did worse. Interestingly, the emerging markets actually started coming out of the pandemic hit that they had in 2020 earlier than others, particularly China, which is the one country of the G20 which saw a rise in GDP in 2020, which is quite extraordinary given that, of course, they went into a deep lockdown to begin with, much earlier than everyone else, but they did come out of it quite fast. With it, of course, quite a lot of East Asia countries in particular benefited from the increase in demand from China. Manufacturing production rose quite significantly, and they've been able to export quite a lot to them too. So the whole region did better than the rest. The forecasts are for the world economy to grow quite strongly in 2021. Remember, this was end January and countries had already gone into a renewed lockdown. So you may think this is slightly optimistic, but even with this optimism, certainly the advanced nations did not get back to where they were in before the pandemic actually hit until 2022. In some cases, late 2022, and I'll take you through some of that in a minute. The emerging markets do better. That, of course, has all sorts of repercussions too in terms of the power balance between China and the rest of the world. And of course, we have a new regime in the US, and that's going to be a very interesting one to watch as well as to how those relationships develop in the future. But this uncertainty is there. I already talked about that. It remains at historic highs. We haven't actually seen that level of public policy uncertainty in particular. And that little blue dotted line is a sort of 6-month average. And although it is coming down a little bit towards the end, you can see right to the top right-hand side, there's a little bit of an improvement. That's mainly because of vaccines coming on board, of course. We're still having a market which is not quite sure where things will go next. Of course, on our daily lives, we're seeing stock markets in fact, being very strong right now, loads and loads of money prepared to go into new IPOs, as we've been hearing on a daily basis. So there is money around and people are looking for returns, but the uncertainty is still there. And the real worry is, the figures that I showed you before, are they going to materialize? There has been a slowdown in the beginning of 2021. Here is China. I already mentioned how well they were doing, very substantial improvement in production and even in consumer spending. But here you are, the industrial confidence index is beginning to slow down, and it slowed down actually quite significantly. If you look at other areas, here is the US, which despite very substantial number of cases and lockdowns in different states, a different pace. What we saw was quite a substantial improvement in output happening from the depth of the fall that it had in the second quarter in particular of 2020. Employment has improved. It had gone up to something like 16–17%, is now back down to about 6%. There was no furlough scheme there. They just all got checks through the post and a lot more unemployment benefit. But what you've seen is even there, the beginning of 2021 saw a slowdown happening too. And then if you move to Europe, this is January 21 latest EU consumer and business confidence. What you're seeing is that economic sentiment and employment expectations have been decreasing in the euro area and in the EU as a whole at the beginning of this year, because again, more lockdowns in various places have been introduced because of the increase in cases that we had seen. But there are some good news. It's not all doom and gloom. In fact, if you look at the overall movement in terms of the average of new cases that various countries have to deal with, you see that there is now a bit of a slowdown. In fact, you see the peak in some countries happened at the end of last year. So there is hope. And with vaccinations, even though they're slightly slower in terms of getting them through to the population than is the case in the UK, you've seen that trend accelerating there too. So looking ahead, this is a source for rejoicing really that the economies will be doing better in 2021. The question is, of course, when does that improvement start? And it may start at different paces in different countries. But what you see is that the hit in 2020 has been really quite substantial. This were again the latest IMF forecast. Of course, we've had some data for the UK since, which more or less confirms the figure that they had there. It shows that among the G7, remember Spain, which is slightly worse than us for last year, is not in the G7, but among the G7 we had the worst fall in GDP to a considerable extent. This is accounted for by the fact that we have quite a high percentage of services in our economy, but in reality we also went into lockdown a bit later. And also, of course, we've had possibly the impact of Brexit and anticipation of a no deal and concerns about investment and so on coming through. But we had a pretty bad early and middle of the year. We have bounced back, but a slowdown is taking place again recently. Of course, the faster you fall, the faster you're meant to be picking up. Well, it doesn't show that particularly in these figures, but what it does show is that with a bit of luck, our improvement continues through to 2022. So a lot depends on the types of policies that we see in the future and the extent to which the government continues to support the recovery. In other countries, overall, an improvement again. So if this really happens, then we can sort of keep our fingers crossed and hope that the environment generally will improve in terms of business and employment, although we are starting from a very low base, and it's worth reminding ourselves of that. The low base is shown here, the very substantial drop in GDP. But the interesting thing is that we have managed to escape the double dip. Europe, that I mentioned earlier, had a contraction in GDP in the fourth quarter. We didn't. We just about, on the figures that we've seen released, everything can be revised, of course, we managed to avoid a contraction. Then there will be, of course, a contraction in the first quarter, but it means we're not going to have 2 quarters of negative growth. But we are still, as you can see, something like 7 to 8% below where we were before the crisis hit. So there is still a lot of room to catch up. But what has happened, because we've actually done reasonably well, is that there has now been a new look at where the UK stands. Vaccinations, of course, are proceeding, as I mentioned earlier, at a very rapid pace. A lot more confidence in being able to get out of the problems we've had perhaps faster than others. There has been a reassessment of the position of the pound, and you've seen it's almost gone back to where it was before the referendum in 2016. Now, whether that's good for exporters, which are, who are already facing quite a lot of problems, is a question mark. But of course, what it does mean, particularly since we've seen some rise in inflation recently, and of course the data this morning confirms that as well for January, in the UK, still not very much at 0.7%, but nevertheless, year on year, there are signs that inflation is picking up, and the expectations are that it will. That, of course, the sterling being higher would mean that perhaps that inflation pickup might be more muted, but let's see what happens in the future. Of course, we've also had the weakness in the dollar, which is seems to be quite entrenched, but that, of course, could change at any moment. But for the moment, sterling seems to be very much in demand. That inflation pickup that I mentioned is also reflected in yields. There had been an expectation that the Bank of England was going to consider more seriously reducing rates to negative. I mean, we do have negative rates in the European Central Bank, for example, and Japan has been struggling to keep rates at any positive level for a very long period of time. But what you've seen is that there's been a bit of a re-estimation of perhaps where we might be going. Not huge, but a little bit. So the dark blue line at the top is the latest one. You've seen that the yield curve has steepened a little bit. Just looking at today's rates, you still, of course, have negative, just negative for the short-term bonds, the yield on the short-term bonds, but what you've seen is a bit of a pickup in 10 years and 30-year bonds. Not huge, but a little bit, still way, way below 1%. So Q1, I mentioned, the outlook looks a bit bleak. We've been hearing so much now about what sort of lockdown plans there are in terms of easing some of the restrictions. We're going to hear a little bit more from the Prime Minister in the next few days. What this means, nevertheless, is that Q1 is likely to be probably negative. You see that already in the January data, which is the composite PMI. You see a reduction. Anything below 50 is a contraction in the economy. Interestingly enough, manufacturing has been, in general, quite strong, but that's slowing down as well. Construction, which had been very strong since the summer, also suffered in December, in January. So that is affecting the figures, and it's probably not going to be particularly good over the next few months. So we've got that problem to deal with. Manufacturing business confidence has also gone back down. It had improved to 0 in the previous quarter, but early 2021, we're seeing confidence dipping again. And of course, all eyes are now on the budget of March the 3rd to see what it actually has in it for businesses for the future. The consumer, however, feels a little bit more optimistic. The latest CBR YouGov confidence poll suggests that there's been a little bit of an improvement. Now, remember, we've heard quite a lot from the Bank of England's chief economist, Andy Haldane, reminding us that there is a lot of money which has been saved, something like 125 billion for the moment. All these people who have not been going to work but have been still paid, or even those who have continued going to work, at least continuing to receive some income which they haven't been able to spend because so much is closed in the economy. Clearly, we still have quite a large part of the economy operating, but the ways in which you can spend your money in any leisure activities has been hugely restricted. So this 125 billion that we have at present is expected to be something like 250 billion by June, according to the Bank of England. And we may indeed go out and spend it all. Well, it's questionable, of course, whether we necessarily will, because there are quite a lot of uncertainties around, and those uncertainties have to do with the way in which various sectors have been affected by the pandemic. We can see the impact in the percentage of workers who have been furloughed in different areas. And of course, if you go down the list, when you get down to energy, for example, and agriculture, you see very, very little evidence of any furlough going on there, but you move slightly higher up and you can see where the impact has been. Accommodation, food, services, of course, in particular education with the closure of schools, but then the whole entertainment sector, arts, entertainment, recreation, and lots of other services. Transport, where of course the government is now taking over, sort of basically running, and will probably carry on doing so, quite a large part of train services, but that of course has reflected the fact that people are not traveling as much with public transport. Financial services, although they've managed to carry on operating with huge support, have still been hit, and so on. So there is concern that a number of people will lose their jobs at the end of the furlough scheme. Now, this showed you what was happening in the middle of the year. What happened afterwards is, of course, the opening up, quite a sharp reduction in the number of people in the furlough scheme. Of course, unemployment did go up. It's gone up to about 5% now, but furlough numbers have gone up again with new lockdowns, and it's anticipated now that compared to the 9.5 million at the beginning of the pandemic, we now have about 4 million who are on furlough. That's still a very large number, and there is a question mark as to how many of those will be retained at the end of the period in April, but of course that may be extended even further. So will the people spend the money? It's questionable. And will the government carry on having to support the UK economy? The answer is probably yes. We can see here that very much like other countries, we have also had to borrow a lot and spend a lot during the pandemic. The interesting thing, of course, is that many countries like ourselves started this pandemic with a lot more debt, both public and private, than was the case at even the beginning of the financial crisis. What we've seen is that our debt to GDP ratio has already gone above 100%. It may go up even further. And the amount that we had to borrow this year is something like 400 billion, which we haven't seen in a very long period of time. And you can see it here. This was the latest forecast of the Office of Budget Responsibility last November. Of course, there'll be an updated chart appearing with a budget on March the 3rd. But what it shows very clearly is that that borrowing isn't going to go away. We're still going to be borrowing something like 100 billion in 2024-25, and we will need to have access to the market. And of course, to a considerable extent, this has been possible without having to pay high interest rates, because the central bank has been helping hugely with quantitative easing, which matches almost exactly the amount of money that the government has to borrow. So anyone who comes into the market feels confident that they have someone who step in and buy their bonds if that's what they want to do at the end of the day. And that's exactly what's been happening. The bank balance sheet's been going up, and it will continue probably to do so. As you see, with the high unemployment that is now forecast at 7%, possibly at the end of the furlough period, the government will have to continue to support the automatic fiscal stabilizers work. You collect less, you pay more if the economy isn't working as you'd like it to, and with high unemployment. But with an improvement in growth, hopefully that debt to GDP ratio will come down. What other measures there may be to try and correct all that in the future, we will await the Chancellor to give us a few more hints in the March budget. There will be an improvement, though, in the deficit to GDP ratio, because we're not going to be borrowing as much. Are there going to be new fiscal rules? Everyone is urging the government not to move back into austerity mode, as we saw after the financial crisis, and delay tax increases, and also continue with quite a lot of the promises of the infrastructure spend that had been made at the time of the elections back in 2019, and the levelling up agenda, of course, that the government is very keen to pursue. Will there be any money actually left for that? Is questionable. And then there's Brexit. Just to remind us, the forecasts are pretty dire about the impact of Brexit. Of course, COVID has made it much harder to tell one apart from the other. We have seen quite a lot of problems in terms of trade with Europe. We'll hear more about that from Madam Marshall. UK exports to the EU are expected in the long term to come down very significantly, and also it will affect import trade too. Other possibilities of onshoring and substituting, possibly other possibilities of selling to other countries, possibly, but overall UK trade will suffer, and that is total UK trade, not just trade in relation to the EU, because you can't actually make up any losses. And those losses, of course, are likely to be particularly significant when it comes to services, which are the one area where we have a surplus with the EU and a surplus worldwide. I think it is worth reiterating that so far in the agreement with the EU, financial services have been, as the head of the City of London Corporation says, overlooked, which is probably an under emphasis of what's happened. Basically, financial sector has indeed been more or less forgotten, although there are discussions now on how to improve the relationships that we have or will have in the future by trying to get equivalence. Now we've lost mutual recognition and passporting for all of our services, so it's going to rely on having some agreement of what our acceptable regulation system is by the EU, but that of course could disappear at any moment, so a huge amount of uncertainty there. I mentioned the uncertainty at the very beginning. It is particularly strong in the area of services and financial services as well. It is worth bearing in mind that it isn't just a city, which is generally not hugely loved, but there are jobs all across the UK that depend on a vibrant financial sector. We've already seen how much money is moving to other centres in Europe, and the difficulty, of course, of having now to do individual country agreements so that even basic financial services can carry on being offered across Europe. So it is a big issue, which is going to worry us, I think, for some time to come. And worth bearing in mind that those non-tariff barriers are not just in the financial services. This is a slide from ING Bank, but also it looks at OECD data, which shows that as a third country, we have very significant barriers in many areas, whether it's air transport, whether it's actually being able to provide professional services across Europe, whether you're an accountant, an architect, an engineer, and also, of course, the whole haulage industry, which is affected, logistics. We already know, of course, that the UK has lost cabotage in the sense that before you were able to collect goods, go to Europe, and then do 3 different trips and then come back from one place to another to Europe and come back fully loaded again. That is no longer possible. You can only do one of those trips within Europe once you've been there to deliver your goods for the first time. So, and that's similar actually with air transport. So airlines are affected. Quite a lot of them, of course, are changing their status so that they are EU. That's going to be a problem for some time to come. This shows you from a scale of 0 to 1. So if you just very simplistically sort of look at this, it looks like there is, in terms of the cost or the barriers to trade, they've increased by something like 50% or 40% and so on. So it's pretty negative, and this is an area that will require an awful lot of attention for the future. And then finally, just to put all those figures that I showed you about Brexit into perspective. This is a slide from the National Institute of Economic and Social Research. It doesn't really disagree much with what others are saying, which is basically that we have already lost something like 2%, if not 3% of GDP by comparison to where we would have been if we had voted to stay, mainly because of reduced business investment, which we're suffering from still. The expectation is that after 10 years, we will have lost this type of output of about 4% of GDP, and just not going to regain that. That is made up of, and of course, we lose trade with the EU. We make up a little bit of trade with other countries, and not just the Anglophone ones, but also more widely. And we lose quite a lot in terms of foreign direct investment, as we're no longer going to be a gateway to Europe. Migration, which will be reduced in net numbers, particularly from the EU, means that quite a lot of the talents that we would be getting are not coming in, and migrants as a community pay more into the exchequer than they take out. They're about the only part that contributes positively. But then, because of course we're losing this big market, at least we have barriers to this big market. We're not losing it completely by any stretch of the imagination, but we're having barriers, and we can't compete properly as we did before. You lose quite a lot in terms of productivity, economies of scale, and so on. The interesting thing is that some of the other forecasts are bigger, that I showed you before, in terms of the loss. And the worrying thing, the latest Bank of England note that came out just recently, suggests that a lot of those losses will be at the beginning. They will come early. You don't have to wait 10 years. They will happen in the first 3 years. So coming out of the pandemic, therefore, just to sum up, we are going to have to face the double problem of getting the economy back to normality, in inverted commas, and also, of course, dealing with the fallout in terms of businesses, supply chains having been interrupted, and the productivity issue, which has been a perennial problem in the UK for a long period of time. Thank you very much. I will now move on to Adam Marshall, who runs the British Chamber of Commerce, to continue. Thank you.
Well, thanks very much, Vicky, for a masterclass about the macro picture. What I'd like to do now, if I can, is to pick up on how the current global situation is affecting different sectors and individual businesses at a more micro level. And what I'd like to do, if I can, is to talk just very briefly about 5 key issues affecting businesses and our business communities right now. The first is working capital. The second is trade barriers, building on some of what Vicky has said just a couple of moments ago. The third is the set of policy changes that we expect to see coming over the next few weeks. The fourth is around staff and workforce. And the fifth is around cities and place. So starting with cash flow and working capital, what every survey points to is that cash is the biggest single preoccupation for most of our businesses at this stage of the game. And unfortunately, we have many companies across the UK who are running on empty. There are real concerns out there about what could happen in the second and third quarter of this year, particularly for companies in sectors that have been wholly or partially closed, who have seen their demand literally cratered by coronavirus-related restrictions. There you would point in particular to hospitality, to leisure, to tourism, and to the aviation industry. But also, of course, all of these industries, all of these businesses have very long and very deep supply chains into their local communities. So the risk of any one of the big and well-known companies in this area, of course, is not confined to that individual company, but indeed is spread across wide supply chains around the UK and indeed around the world. And that is a huge concern as we look into the periods to come. With cash, we have some companies out there who've had what you would call a relatively good pandemic, and they do have money on their balance sheet, but they're nervous about what might come next, and they're planning in a very conservative way. The others in those sectors that I have mentioned have gone through the cash that's on their balance sheet and are really facing some serious difficulty. And I think what that highlights is the importance of working capital, so that some of these companies have the chance to rebuild their demand over the coming months as they're allowed to reopen. But then we also have an issue around growth capital too. Lenders are going to be more risk averse, I think, over the coming period of time than perhaps they have been up till now. The government lending schemes and some of the support that's been available over the course of the pandemic will start to recede at some point as we reopen. So the availability of growth capital through both equity and debt is going to be hugely important to so many of our businesses, and actually to reaching that high level of growth that Vicky showed you a few minutes ago that's predicted by the IMF for the coming years. So organizations like my own, the British Chambers of Commerce, are working a lot on questions of how to recapitalize some of our businesses, and in particular our SMEs, and where those future sources of growth capital are going to come from to make sure that businesses can take risks and reach their potential. The second issue that we are facing at the moment is around trade barriers. The picture I'm showing you right now is one of Operation Stack and Operation Brock on the M20 heading towards the Channel Tunnel in Kent. It's been the scene of a lot of difficulties over recent months, some of which have been COVID related and some of which have been Brexit related. The French government's decision in late December, for example, to impose mandatory COVID testing on hauliers going from the UK into the EU caused enormous backlogs and enormous issues. But actually, that's just the end of almost a year's worth of COVID-related disruption in trade and logistics that so many businesses have faced. Right now, a lot of our ports are full of containers which actually need to be on the other side of the world for global trade to function normally. And there are shortages in some of the key places, particularly in East Asia, where a lot of the goods that we consume are used. So there are some serious logistics and supply chain issues affecting a lot of companies as a result of the pandemic and as a result of the crisis. And I think I see a lot more businesses now putting emphasis on supply chain resilience than I ever have before in recent years. It seemed like those supply chains just got longer and longer, and more precise. And of course, whilst that cut costs for many businesses, it didn't leave many with a lot of resilience. Now, with the logistics difficulties we've seen and the supply difficulties we've seen in so many industries, people are thinking again, and making sure that resilience is there has taken a priority over the lowest possible cost. And I think we'll see that continue for a lot of companies as they look at their planning over the next couple of years. So there have been a lot of COVID-related trade issues, but of course, as Vicky has stated earlier, there are also a lot of Brexit-related trade issues as well. On the 1st of January, the EU implemented the application of the Union Customs Code to anything coming in to the EU from the UK. The Northern Ireland Protocol on the movement of goods between GB and NI also came into force. We've all seen some of the well-publicized teething difficulties that both of these shifts have had for many businesses. But ministers out there are keen to characterize everything as a teething difficulty, and that some form of adjustment will happen and all of this will just go away eventually. I would strongly disagree with that point of view. There are some adjustment issues out there, but some of these changes are structural in nature and will result in a lot of businesses simply not being able to access their markets and carry out their business strategies in the same way that they did before. The first example we see of that, of course, is things like Scottish seafood producers unable to get their product to continental customers in time before the product spoils. But not just in the food and drink sector, but more widely, a lot of business models are having to be reassessed because of Brexit-related trade issues. Just to give you a statistic, the cost of transporting goods to the UK from various EU destinations in recent months has been 10 to 30% up on what those costs were in the third quarter of last year when we were still in the single market and the customs union. Some say that they're starting to settle down and that they're starting to get into the high single figures. That's good. It means that some of that initial shock is receding. But what may be left is a residual structural impact of higher costs for the long term for businesses trying to move goods across borders. All of this has been accentuated too by loss of connectivity, because we've seen so many of the air routes as well, which carry a lot of our higher value goods. And of course, our highest value thing, which of course is brains going out to service clients from services industries around the world, we've seen a huge loss of connectivity in recent months. All of that is related to the pandemic, and the early re-establishment of those trade routes for both services and goods and those air connections is absolutely key. I have a big concern, which is that our aviation industry is not getting significant support and may be very slow then to come out of the crisis that we are facing, and that then has a huge onward impact on so many businesses and so many supply chains as well. So there are some real trade issues that individual firms are having to contend with, and a lot of these issues are likely to persist for some time. The third area that I wanted to discuss today is, of course, the policy environment facing businesses themselves. The Chancellor of the Exchequer shown there holding a budget briefcase. I would say this Chancellor of the Exchequer probably holds the record for giving more budgets than almost any other in such a short time in history. They just haven't been called a budget with a capital B, but there have been so many packages of support and adjustments to the fiscal environment because of needs during the pandemic. Now, I want to give Rishi Sunak some credit from our business communities. Actually, a lot of the schemes that have been put in place to support businesses have meant that they have not gone into insolvency and have not been wound up. So the furlough scheme in particular, the job retention scheme as it's called formally, the most important for many firms, but so too have been things like business rates holidays, VAT deferrals, and much more besides. On the 3rd of March, at the Chancellor's budget, we want to see that support extended through to the end of the fiscal year 2021. Very important to see support kept in place. Otherwise, the 280 billion that has already been spent supporting businesses could be lost in part because businesses fail as we come out of this. I liken the experience businesses are having right now to a marathon. They're within sight of the finish line at the moment, but once they actually cross the finish line, they need a space blanket and a bottle of Lucozade and some tender loving care to recover from the race that they have just run. And that is maintaining that support through to the end of the year. The Chancellor's also got to come out with incentives for future investment. Now, I mentioned that there are companies that are successful despite the conditions that we're facing right now, and they have got cash on their balance sheets. If we want to see growth in the coming years, those companies have to be incentivized to use that money and to take some risks on growth. So some big incentives for investment will also be important. And above all else, in order to ensure confidence, we've got to see business tax increases avoided. We've got to hold off for a couple of years and let the government balance sheet take the strain to get the economy recovered before we start talking about paying for the consequences of the pandemic. Otherwise, the growth that we all want to see and the reestablishment of business that we all want to see could take longer. All of this, of course, will have an impact not just on business operations, but also on sterling as well. We've seen, even just in recent days, with discussions about the roadmap out of lockdown, the UK's vaccine programme, the expansion of testing and financial support, we've seen some interesting impacts on currency. I would suggest that we may see that continue as well if we start to see a sustained reopening and a recovery, and that's another thing that many businesses will be paying close attention to. Next, of course, businesses are also worried about their people. This graphic, I think, represents what a lot of us have felt over the past year, which is that we are doing everything all the time at all hours of the day, and our home and work lives have effectively melded. 1 year on, there are still 40% thereabouts of people in the economy still working from home. There are others who are working in a flexible and hybrid way. And we're seeing some of the impacts of this on staff. There are mental health impacts affecting a lot of businesses. There is stress-related illness and depression that have affected many too. And there are big questions being asked about what a successful return to the workplace and what a new working culture will mean for a lot of our businesses all across the UK. And that change to working culture, there are those out there who say that they know exactly what it's going to look like and we're all going to work from home forever. I think they're wrong. I think those who say that we're all going back to the office and we're going to forget that this ever happened are also wrong. The reality is somewhere in between. We're going to end up with a hybrid working life and a hybrid working world, and we need to start having open discussions in our businesses about what that looks like and how that affects our productivity and our ability to be successful. I think that will be a huge discussion in 2021 and indeed beyond as we try to navigate the aftermath of the pandemic. And finally, I wanted to touch briefly on cities and place. The picture in front of you, of course, is the heart of the City of London, an area right now where declines in footfall are around 85 to 90%. In many of our other major city centres across the UK, you've seen declines of 80 to 90% as well. That has profound impacts on the way we use places. And the concentrations of business and economic activity and where firms choose to locate. And I think that all of that will be another impact of the pandemic and something that will need to be worked through. Retail in our cities and city centres has gone through a torrid time and is likely to change beyond all recognition in the aftermath of the pandemic. But what then replaces it at the heart of our cities? Are we likely to see more residential living? Are we likely to see more entertainment and culture businesses once those activities can start to restart and the experience of the city coming back through again? That will have impacts on a number of places around the UK and the economic activity within them. and it'll also have impact too on our towns and on our rural areas, because we're going to see a real change in the way we organize economic activity and our working lives in this country. So cash, trade barriers, government decisions, staff and people, and cities and places, the 5 things I think will be affecting businesses of every sector and every size from here through to the next year. Stuart, on that note, I'll hand back to you.
Thanks, Adam, and thanks, Vicky. That was excellent. We've had a number of questions come in during both those presentations. So I'm now going to hand over to Lee from Moneycorp to host the Q&A session with Adam and Vicky.
Thank you, Stuart. And thank you to Vicky, thank you to Adam. It's great to work with you both. Adam mentioned a masterclass. I think that was a masterclass from both of you. So thanks for that. Thank you very much. So here at Moneycorp, we talk about financial supply chains a lot. I think that's sort of a term that maybe previously people weren't really too au fait with or too aware of, because it was kind of just business as usual. But as we move through this new post-Brexit landscape, one of the questions that's coming for us is, what would you say are the most realistic pressure points and risks surrounding supply chains in general?
Perhaps Adam can take that one first.
Lee, I think there are a number of issues arising here for businesses. I mentioned the question of supply chain resilience, I think is one that many businesses are having to take into account. One of the ways we're seeing that is people thinking about what the backup strategy is to congestion at a port, for example, or disruption over the short straits, and how they might move their goods around effectively from place to place. That means making sure that you've got a customs agent that could handle some of that unpredictability, and that your freight forwarders are working well. It also means that some of the steps in your financial transaction chain may need to be adjusted, and some of the assumptions that you had previously made need to be adjusted too. So we see businesses will need sort of alternative strategies, and they'll need to be working with a range of different providers to make sure that all of those alternatives are in place if they need to activate them.
Perhaps I can add that what we saw at the time of the previous financial crisis, we don't have a financial crisis right now, but it may come if indeed quite a lot of sectors are in difficulties when we get out of the pandemic and there's no longer any serious government support for them. But what we saw at the time was that there was a serious disruption in terms of trade across countries, but also there was just no confidence in the banking system. So remember what happened to the interbank market at the time, and people just could not get credit. So there was a huge credit crunch, and the government stepped in and gave support by basically creating its own sort of trade finance product that could be taken up by exporters. What happened, of course, is that the banks in the end sort of reacted the right way, so that product was hardly used, but at least it acted as a support mechanism, if you like, to ensure that trade started flowing again. What we've got now is not only do you have this whole problem about the supply chain being disrupted because of COVID, and as Adam was showing in terms of the links that existed before between countries and the way that freight was moving, obviously if that doesn't happen anymore, you can't really have a proper supply chain operating. You're going to have to think of alternatives. So you already have had the need to rethink how that might be positioned in the future, and it may be indeed the case for some onshoring to happen again and rethinking supply chains, but also with Brexit too, where we've seen that quite a lot of firms are just relocating, let's say, their warehouses to some other place in Europe, so they don't have the problems that we've just had here in the UK, which means that you're importing something, trying to re-export it, and there are tariffs there. But there's a more basic issue when you think about financial. I mean, first of all, unlike, I would say, Germany, you don't have the sort of structure where the sort of supply chain you're part of supports each other financially as well, number one. So we may need to think a little bit more about how that can be reintroduced. I think we used to be much better at that in the past, but that's all disappeared. And the second thing is the type of insurance that is actually needed. We've seen the problems with pandemic insurance and the question of sort of reinsurance. Is there enough security there, if you like, for firms as they're starting to recover and think of different ways of restructuring themselves that there will be this backup there, and that any other interruption in the future is going to be supported, in, if you like, with them being able to have recourse to something, at least in terms of that type of security. And that requires possibly some government intervention, but also maybe the industry thinking again in terms of the type of product it offers to those firms which are definitely going to be in need.
And I think I'd add one more point, Lee, which is around the possibility of currency volatility. Whilst the Brexit agreement is now in place and we know what sorts of arrangements we're going to have for trade with the European Union, we've seen already with the political argument over vaccine distribution just how fragile that consensus is. And of course, that spills over a bit into currency markets and could have impacts on many importers and exporters who are trying to move goods across borders. So I think businesses will probably be thinking a lot more about currency volatility and potential currency risk than they might have done in a more settled environment.
Thank you both. So clearly logistics is key to many things supply chain. So one question that's come in is, how do the numbers of logistical issues we're seeing now compare to those during the Brexit transition period? I guess that's a question of post-Brexit realities of dealing with supply chain, but also what curveballs are COVID potentially thrown in there as well.
It's really hard, this one, because of course during the whole of the Brexit transition period, the 11 months of that transition period, we were dealing with and firefighting the impacts of COVID on trade and logistics. So there weren't really any Brexit related impacts during those 11 months because none of the border procedures were any different to what they had been for the past 40 years as part of the single market and the customs union. The impacts were all COVID related during that period. And as I was saying before, logistics being out of place and people having trouble moving stuff because there was either no capacity, no containers, or no one willing to move goods for them. But if you just look at it in strict Brexit terms and forget the COVID stuff for a second, everything changed at midnight on January the 1st. And you saw in business activity a huge amount of stockpiling going on in December of last year, and the decision to move as much stuff as possible to be as ready as possible for disruption on the 1st of January. And that was businesses taking advantage of the status quo before it shifted and before some of that uncertainty and additional cost and additional bureaucracy was introduced. So it's entirely logical behavior. We are still not through the logistics issues either. We're only 6 or 7 weeks into the new reality. And of course, there are impacts on imports still to come. The UK government has said it's going to introduce SPS checks on food and agricultural products in April, and that it's going to introduce full customs procedures and inspections on everything from July. So imports have not seen the full VAT regime just yet. So there's more change still to come. We would urge the UK government to proceed slowly with this, because the thing that you need to do is to work through these changes, not just introduce them and leave businesses to their fate.
Well, the other thing perhaps to add is that being able to use data properly in any logistic firm or in any arrangement you may want to make is very significant. It is a significant part of what the whole process requires. And of course, we have a bit of a problem right now because we don't have a regime agreed yet on data adequacy, and therefore transferring information from the EU into here, or even vice versa, is a real problem. So if you're dealing with the EU and you can't actually, or you're not sure how you would be able to use the data in the future, is a big issue. There have been some rumors that maybe some agreement is about to be reached, and it was in the papers just recently. But until that happens, there is, of course, a temporary agreement that we can just carry on as normal. But if you don't have a more sort of stable basis for data transfers in the future, then that's going to seriously affect, I think, the logistics sector and actually the wider economy, because it affects small firms, big firms, insurance companies, banks, etc.
Thank you. So we've had loads of great questions through, and we will endeavour to ensure that we answer any other questions that we can't get through today. But I'm going to move to the final question now, which is for those businesses and sectors that are trade intensive. What are the stress points and challenges that they're now facing in the world that we live in right now?
Gosh, there's so many. It's I'm sure Vicky and I could produce an extremely long list for you, Lee. You know, we talked about currency volatility. We talked about logistics difficulties and transport volatility. One thing that we haven't touched on too much, though, is services businesses, who of course provide a huge amount of the UK's exports and also where a lot of the UK's potential future growth lies. Those businesses have issues around mobility. You know, can they move professionals from place to place in order to carry out a contract? They have some issues around legal certainty of contracts and venues and cross-border issues that they perhaps didn't have prior to Brexit as well. And of course, the question of the recognition of professional qualifications. So if I'm an architect from Cornwall, can I do something for a customer in Munich in Germany, for example? So these are some big issues, not talked about as much as trade in goods across borders, because we can see, touch, taste and feel what happens when the lorries stack up on the M20 or when the supermarket shelves don't have our favorite brand of French or Italian cheese, for example. What we can't see are some of these more intangible impacts on the services sector, which are also trade intensive, and I think it's important that we recognize them too.
Well, I agree. Services, as I remind everyone, are such a substantial part of the UK economy, and of course financial services too matter hugely, and they provide a lot of services additionally to the economy. So what Adam was talking about in terms of professional qualifications across Europe, of course, matters hugely also in the UK, given that there are so many of the professions, whether they're accountants or, of course, the banking industry and so on, that do all interact with each other and provide, look at the city, provide a sort of ecosystem that we have developed over a number of years, decades, centuries, which has ended up with London being such a big financial centre, but also the UK being very strong in that area. But I think in terms of businesses going about their sort of normal day-to-day affairs, the uncertainty that's out there is, I think, going to be something that is going to be with them for quite some time. As Adam mentioned, what's going to happen in the budget is crucially important. Over what period will we start needing to raise taxes? How will business investment recover when you don't really know what type of environment you're going to have? The whole regional aspect, where that infrastructure spending might actually go, what type of regulations there might be, because we are coming out of this, or we will be coming out of this crisis with probably a lot more concentration in various sectors. Are the competition authorities going to worry about this? What's going to happen to the prices that perhaps can be charged for various service provisions, such as, for example, energy? We're already seeing the cap on energy bills being lifted a little bit. So what would happen with transport? Who's going to run them? The services that are there now, buses, trains, etc. And where will some of the money that had been promised actually go? And will it still be good value for money? Huge issues. And then, of course, there is the international trade environment. So the business has a lot to worry about, obviously, and then Brexit, as Adam was suggesting. I showed you the uncertainty index. The expectation is that it will stay quite high for quite some time to come, even if the vaccine distribution is hugely successful, because all these other unknowns are still there.
Let's just though end, if we can, on a positive, which is, I mentioned earlier that a lot more businesses are looking very carefully at the resilience of their supply chain. And I think that the reviews and the hard questions that businesses are asking themselves about supply chains right now will bear fruit in the coming years, because they'll diversify those supply chains. And in some cases, we may see some of that diversification, including more homegrown solutions as well here in the UK. So what I hope, and I hope the UK government supports this as well, is that we take a long, hard look at all of our business supply chains and all of the supply chains that are of critical importance to the UK's national economy. Not to onshore everything and stop trading and pretending that we can substitute for imports and do everything on this little island, but making sure that as an open economy, we're still a resilient economy rather than one that literally gets hit by every shock out there. And I know we will want to work very closely with government and with all of the players in industry who are looking at supply chain resilience over the years ahead, because it's going to be absolutely critical whether you're in manufacturing or in services or in the B2C sector to ensure that that happens.
Thank you very much, Vicky. Thank you very much, Adam. Some great insights, and hopefully our viewers today found that very useful. So I will now give you a short explanation about the relationship between Moneycorp and Achilles, and how we're helping the Achilles network to manage risk and save money. Moneycorp is a business that's very much based in bricks and mortars. We were founded in 1979 in London, so we have a strong history of over 40 years, but our future is very much that of technology. We have a great platform which we use to serve clients, as well as offering great levels of service and relationship. We serve 10,000 businesses every year and 30,000 private individuals. We deal in foreign exchange, international payments, hedging, and we also have a great bank account solution, which a lot of our SMEs find very useful when it comes to international trade. We're a specialist, not a generalist. So 80% of UK SMEs still work with their retail bank, who may be more generalist in their approach rather than someone like Moneycorp, who are very much specialists when it comes to international trade, especially when that comes to the world of payments. We help international businesses to thrive. And as Stuart mentioned, we are delighted to be partnering with Achilles. In short, the partnership with Achilles will enable customers to access cost-effective expert guidance on international payments and currency exchange. And in doing so, we will be reducing supply chain currency costs and increase efficiency. As we've mentioned a couple of times through the webinar, financial supply chain is something that's very much on the mind of businesses, of SMEs right now, something that maybe businesses weren't thinking about so much before, but in this post-Brexit and COVID world that we live in right now, that the robustness of financial supply chains and the ability to access multiple solutions through multiple providers are very much key to ensuring that businesses are in a good place as we get through the challenges thrown at us in the current world. We will be helping the worldwide network of buyers and suppliers to be able to streamline their business payments and also access our innovative single IBAN bank account solution, which I referred to earlier, whereby businesses can accept and trade 40 currencies, which takes away a lot of the cost of dealing with multiple bank accounts, a lot of the time that goes with dealing with those bank accounts as well. We will be offering financial health checks to any Achilles members, so that is something that you can definitely look at on the website. And if you'd like to find out more about our partnership, please visit moneycorp.com/Achilles. Over to Stuart to wrap up the webinar.
Thanks, Lee. So sadly, that's all we have time for today. If you still have questions, please do add them to the chat feature, and we'll be sure to answer them all individually by email. And if you'd like to talk to a member of the Moneycorp team for a free no obligation health check, there may be significant savings available for yourselves if you trade internationally. So you can call the team directly on 020 7139 0300 or email us at achilles@moneycorp.com. Finally, I'd like to thank our speakers, Vicky and Adam, and thank you for your time, and bye for now.